PE expansion and PE contraction. These two things in the stock market decides many people's faith. Remove those two things and the people who see around you, from Ramdev Agrawal to Warren Buffett to Vijay Kedia, anybody who has invested and gotten successful, would not exist if you remove one single thing, which is PE expansion. And the persons who have lost in the markets, who have gotten out from the markets, name every single one of them. They would have been in the markets if there was not PE contraction. These two things are such important that these two things can totally make or break your journey of stock market and of millionaire. So in today's video, I am gonna discuss about PE expansion and PE contraction, how it works and what is it. So let's first start with why companies' price to earning ratio is changed. It sometimes gets higher and sometimes it gets lower. To understand that, you have to understand the concept of value and the Mr. Markets. Value is the basic cash which company will earn in future or has in present, and those can be decided by the ratios and the earnings and the expenditure and the dividends, all these combined, and the liquidity in the markets and such other things combined, you get the value. So if you get the value of, for example, price to value of 10, price to earning ratio of 10. Now in this example we talked about value, but in PE ratio expansion, the value word gets eliminated and the word PE expansion is introduced, or P is introduced. Now whatever the earnings, price to earnings ratio will expand from here, from the base, means from 10 it got to 15 or 30 to 40, it is PE expansion. There are various reasons why it happens. First is, as you know, that price to earning is based on value. So first reason is change in value, change in management, change in margin, change in earnings. Second reason can be liquidity in the markets. Third reasons can be sentiments of the markets or news. So if we go to earning ones, either the company's share price increases and the earning remains same, then the price earning ratio increases, either earning decreases and the share price remains same, and then the earning price to earning ratio increases. That kind of you don't want. And the second and the third, when both increases but share price increases higher than the earnings increase, that kind of PE expansion you want. And the first one too is somewhat desirable, because the first one is not sustainable. A growth in company's share price is not sustainable with the not growth in company's earnings. So that company's price to earning grows or share price grows, the company's earnings should too grow, or somewhat they should make believe the markets that our earnings will come in future, like how Zomato had. There need to be a coordination of earnings and of share price, then only the share price increases and then only the PE expansion happens. So the same happens, the vice versa of the same happens for the PE contraction one. As PE expenses, just because change in value up to upper side, just in change in value in prescription of what market thinks, means of rate cuts and growth in the company and such other things, news and liquidity, cash, retailers mood, and how they are entering into the markets, what they are thinking, who is influencing them, all those, how they change the value of the company, prescribed value of the company, like that. If it is changed to the lower side, the lower optics, then the P compression happens. Means it mostly happens in bear markets, and P expansion mostly happens in the bull market. I will show you some example which, but why it happens, it simply, if you say it happens due to vice versa, if it which were stuck in cash and retailers getting out of the game, because sometimes the game of P expansion is built surely on the basis of growth, but what happens in bear market, due to economic reasons only the bear market comes. So the growth which you and us were seeing in the future through book value and through other stuff, the growth which was not sustainable, means of a tender company, of order book companies, for them they will fall, their P will contract, because they do not have the sustainability of earning. But if the P expansion happens with a good and great quality of company, then it will wait, it won't fall, the P won't contract as such, it will wait for the earnings to catch up. Example was of HDFC from 2002 to 2005 or something. Now when you know why P expansion and P contraction happens, so there's the time to know how it makes wealth and how it destroys one, how it can create you and Warren Buffett, and how it can make you fall out of the game like a fly which gets dropped in the chai. Wow. Let's start. See, so we earlier discussed in our channel, if you have watched videos and if you are a regular viewer, we had discussed that companies mostly follows their earning over long periods of time, which is true. Not earnings, the cash flow at the end, but earnings is equal to cash flow, and ROE too is equal to cash flow, book value too is equal to cash. So they all make companies value and companies follows over it. So why it happens that P expansion happens, and how we will benefit from it, how it will create wealth for us. So what happens is, simple reason, very, some people have some judgments, some frameworks and some limitations too. So for them what happens is, they will buy only company which is worth more than 10,000 crore, or they will buy only companies which were doing growth of 25% from 3 years. And for retailers, what they think is the earning is sustainable forever. They do not know the price to earning ratio, they keep buying in the herd, they get blinded from the society, and whatever the society tells, they start participating in them. Means a wave of thoughts is created related to that stock. Those all will benefit you. You buy the company on the base level, then when any that kind of thing happens, mutual fund enters when your company got more than 10,000 crore rupees of market cap, it will increase the value of the company, because less free float, first thing. Second thing, big mutual funds means trustability, and then retailers will follow it and liquidity will chase it, and after that a wave may create that this stock does growth and it has potential in future and it will do. Then more people will buy, they will forget that growth has to stop one day. They will forget that the price to earning has gone a lot far from the earnings. Now it won't catch up through sitting, it will only catch up by dropping. So you at the very starting was sitting from the base P from 10 got to 90 due to such reasons, or from 30 to 90 due to such reasons. So in this what will happen is 3 times 3 times will be only made on P, and whatever the share price increase, you say earning increased, you thought the earnings will increase 3 times in 5 years. You did DCF or taken a wild guess assumption, and that happened. Then 5 times or 3 times earning increase, 3 times P expansion, it will result you 3 into 3, 9 times multi-bagger. That's how it creates wealth. And then the game of P contraction happens. Whoever the people who buyed it madly and didn't see the P, buyed it at the P of 90, buyed it at the peak, now the stock will drop as the earnings is not coming. Market thought that the earnings growth is forever, and they forget that not for any single company it happens. Except for SDFC it happened, but remove SDFC, for most of the normal companies not at all. Growth does not sustain more than 5 years. There's a reason behind it, but not in current video. Already it is been going long, so getting longer. So the people who participated in the stocks thinking that stock will rise even more, they will now cry. Why? Because it won't grow more. The P contraction will happen. The earning will remain constant. The earnings may not fall as much, but the share price will fall and deplete the P. They will be thinking, what happened? Nothing happened. Why it's falling? But they forget that it's not how stock market works. The stocks don't in the air keep going up and up and up. There needs to be a reason, and the reason, as soon as most of the retailers entered in it, got ended, because not every single person can be reached at the same time. And this market is anti-retailers first thing. So that's how the game of P expansion and contraction works. And simple thing, if I tell you, simple to simple, very simple, the example would be of coaching shipyard. It started from the P of 10, got to the P of 90 to 100, and it's currently trading at the P of 45 to 30. It may deplete even more, or it may stay here. I don't do commentary on that, although I have done analysis of coaching shipyard. If you want to check it out, you can check it out, but not here. So the coaching shipyard was a prime example of it, of P expansion and P contraction. You can open the earnings chart of the coaching shipyard, see that how much earnings has increased over 4 years of time, and how much the price has depleted. Let me do it for you. See, the company's earnings in 5 years just increased from 638 crore to 888 crore, but the company's share price increased so much so that it led the company's P too much, and from there it fell. A very good example of P expansion and P contraction, and many things can be learned from it. So one point, that the growth reason what market thinks is growth will continue for forever. Diamonds for forever they think, but they are not in the markets, and then it starts going down. The P compression starts happening. The growth shows the picture first. The growth will slowly slow down. It will make you see the saturation coming first. Means if the company was growing at the P of 30, company was growing at the percentage of 30, 31, 33. Now slowly it's coming down, 27, 20, 17, and the management commentary is getting not good. So at the first signs of growth contraction, you will get the idea of P contraction, and at that time it's the good time to exit that stock if that's not temporary, means it has not happened due to any external reasons like flat came or something like that. If it has happened from saturation, then it's very good time to exit it. And when it's a very good time to buy stocks so that PE expansion happens, it is when the companies at past was not doing much growth, or it was doing but PE is not so much. For example, the PE is of 20 or 10 and you are seeing that growth will come of 30% every year for next 4 years, right? And the ROE is too nice enough. Now when you will buy that stock, not at very much PE, at 20p, because it is undervalued at that sense. If 20p, 10p, how lower you buy, the greater the multi-bagger it would be. So at reasonable level you buy it, then the little bit of P expansion means depends on the sector too. Like for sustainable earning growth sector, it would be a lot higher. It may go to 200p, 300p. But if it's little rocky sector, then it won't get as much P expansion. So the sector was too good, means if it was of pharmaceuticals, the most sustainable thing in earnings terms. So, and in that too it was sustainable, it was not like corona's vaccine. Then you buy that company, you are seeing that company's sustainability of earnings, everything is fine, ROE is fine, growth will come for 3 years and the P is of 20, and if the growth comes of 40, so at very soon of 1 to 1.5 years it will go to P of 40, and very soon it will go to P of 80 to 70 to 90, and it will sustain there. Depends on the market cap too and the situation of the markets too. So in that company, if the earning increases by 5 times or 3 times in 5-6 years, and the peaks expenses expense by 4 times, then 4 into 4 or 3 into 4 times your money would be made, means of 12 or of 16 times. And how much did the earning increased? Just 3 or 4 times. So that's the magic of P expansion. And the another magic is of P contraction. There the earnings too does not increases, but the share price decreases as there is no tomorrow. So very great quote for that is, buying great companies at great prices is sound investing or something, by someone, maybe Warren Buffett, and that's what you have to do. Buy great growth companies with sustainable earnings and sustainable ROE and other stuffs with a low value, with a low base of P, so the P expansion can happen. Then you find a very good multi-bagger. But another scenario happens where the growth and the P is as much as is at equal base. Then at that time too, okay, it's good, but little bit of P expansion you will only experience, which would be of 2 times, not much. So it won't prove a very good multi-bagger, but it would prove a multi-bagger. Now the another one is where the P is a lot higher, is of 80, 90, and the growth is of 40%, and you are sure that growth will be coming for next 4 years, 3 years, or if it stops, then too the earnings are sustainable like DMart. Then at that time what will happen is, if it is too much expensive and the growth stops coming, then your share like DMart will stand at a particular place and consolidate like SDFC 2. And if your company does not stop the growth, keeps doing the 40% growth, then too your share price won't increase as much. It will only increase as much as your earning increase, because no P expansion from that point can happen. So that were the quick tip for P expansion and P contraction. If you have enjoyed, subscribe, like, share, subscribe to whom you think it would be helpful. A lots of thank you. I forget to say you subscribe, you should do it from your own, brother, and like too. A lots of thank you. And if you want to check out other aspects of P which decide the value of the company, you should check out my channel and they watch videos what is value and what is earnings and such other stuffs, then only you will know that how much P a companies is good at, how much ROE, and that decides how much P base value of the company. And now you have known that what's P expansion and P contraction. Now the game comes of finding the growth. Now you have known the growth. Now the game comes of finding one. And for that you have to know how to catch stories. You have to know to notice trends, and that would be one of my next videos, not the next one, or not the next one, but one of the next one. Thank you.